Hello, everyone, and welcome to our market alert video for today, which is November 8, 2024. And I think we have a few important things to talk about. Maybe the election, maybe something that might even be more important to the financial markets, and that is the Federal Reserve's decision. Did you guys even know that happened? I almost forgot to watch the press conference. I was so into what happened in the elections. So we have that to talk about. We have a ton to cover. But before we go anywhere, let me tell you who I am. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And we are a firm that specializes in retirement planning. We work with people who are over 50, who are retired or retiring soon. So if that's you, this video is designed for you. I encourage you to subscribe, click on the button below. And so I want to bring our Chief Investment Officer on with me. Jordan, would you care to join with us?
Again,
Hi, how are you doing? I hope all is well.
we're doing great. It's always a good week, and we got a bunch of stuff to think through.
Think through and when the market's up too. That's always a good
That's a good
thing.
one. That's a
That's
good
always good
one.
as well. And I think if I understand the what I read or heard on Bloomberg, the day after the election was the biggest up day in the history of days after the election. So the very well received election, it appears so far. Any thoughts on why that's the case?
Yeah, I think it's I think it's real interesting. I think um right now, the market is looking for a reason that, what can do at this point where the economy is to continue it moving forward. There were a few signs that there might be a little bit of caution, underneath the hood there. And I think the market has received, potential presidential Trump policies as favorable, as a big tailwind. And so right now the market's starting to price in what life could look like. The good news I think for the market too is they have an idea of what his policies look like because we've been here before. So all those things right now are just, I think, allowing the market just to positively digest things and start carrying us forward.
Yeah, that's very true. Investors like to have confidence when they invest. And, one of the things that potentially could have happened was the tax cuts, the Trump tax cuts might have expired, which would have been a big increase in taxes. So there were some things that potentially were detrimental to profits. And as you guys know, we think that profits drive stock prices and higher taxes result in lower profits. And so that being the case, it probably is a great deal of the reason as well. Jordan, why don't you share with us what you're seeing in the market and what's going on and where you think we're going to go from here?
So, again, like you alluded to, the initial reaction, certainly leading into election and the day of and the day after, very positive. So, one thing you always want to see is not just the reaction on the day itself, because sometimes it's a head fake, right? Is do we see follow through the day after? And what we've seen, on Wednesday, Thursday, and even early trading this morning is market continuing to move up. And so that's super positive. If you look here at the chart of the S&P 500, this goes back a couple of years here. What you're going to see is largely an uptrend, right? You're going to have pullbacks and correction along the way, but it's an uptrend. And you see that red line on there, the 200-day moving average continuing to move up. So all this is super, super positive. If you look at where we are right now, we're trying to march, towards that $6,000 price level, and that's a very important level. Every increment of hundreds of thousands is very important. So it'll be interesting to see today if we can get there, if get to that close. But either way, everything is very positive early on in terms of the market reaction.
And one of the areas that has really shot through the roof on the news, and probably it's a combination of the election, but also the lowered interest rates, and that's small cap stocks, right?
That's right. So if we look at us, see if I can go to the next screen here. If we look at, if you look at small caps as an asset class, so small U.S. companies, it's a very important gauge of where the market is. They're pricing growth and optimism or negativity. Because on average, when the market's getting excited about things to come, small caps tend to perform well. And what we saw, at least intraday on Wednesday, small caps were up over 5%. So, that's just very much confirming what large caps are telling to us, that the market is excited about things to come. And like you said, for two reasons, I think. I think some of President Trump's policies will be very supportive for economic expansion and small caps. I mean, most U.S. Americans are employed by smaller companies. And then the other side of it is going to be interest rates. If interest rates still have a path down, and we don't know how far down, but if we feel like, the Fed cuts that started, back in September, if those can continue through next year, cost of capital goes lower. That's very healthy for small companies. And so, obviously for us, we have a diversified portfolio and we hold small caps for this reason. At times it's good where you get that part of the portfolio showing some positive momentum. So it'll be interesting to watch to see if this continues.
Yeah, so small companies are like the proverbial canary in the coal mine. They're more sensitive, and if people are feeling confident, then small companies are where they want to invest in because they have the potential to have the highest returns, and as we've seen, they've really skyrocketed. So
Yes.
I'm going to throw a curve at you and have you skip over the next slide that we planned on talking about, but
Okay.
go directly to the bonds and what's going on with the bond market and and interest rates.
Sure. So I think go to that slide prior. I think we had up there, Cam. Let's show the price. Let's show the yield first. I think that'd be interesting to look at just as a mechanism. So here we're looking at the 10-year yield or interest of U.S. government bonds. So when you buy a U.S. government bond, it has an interest rate or yield that it pays. And here what we're seeing is, over since late 2023, interest rates have been moving up and down as everybody's pricing in where the economy is going to go and where short-term interest rates going. And usually the 10-year yield, where it's set at, is going to be a function of two things. How excited is the market over future economic growth, and what are inflation expectations? And so what you'll see here, especially coming kind of in mid-September and forward into the election, you actually saw interest rates, yields for the 10-year go up. And I think that is, the market is very smart. And that's market getting an expectation that maybe Trump does win this. And if that's coming, there are largely things that are supportive in his policy for economic expansion. But the fear is that, tariffs that he's talking about could cause inflation to come back up or maybe persist. And so the market started bringing yields back up. And really, what we're looking for here, and that's not inherently a bad thing, that's just a repricing. What we're really looking at is, do we get to that 4.5% level? That's the level, at least in the last 2 years, is when we get up to those levels, that's where the stock market tends to find a little problem. Back in April, we had a little bit of a pullback. That's where the yield marched over 4.5%. If you go to October of 2023, that August to September, October level, market went down 11%. That's when yields moved back over 4.5%. So that's really the thing we're watching here just to see there. And right now, we went a little bit higher, but we found some support, and then yields have backed off in the last couple of days.
So this is what interest rates are doing on the 10-year treasury. And so they've risen, and you're saying that 4.5 looks like if it gets to that, it tends to bounce off of that and come back down. And so what does that mean to the price of bonds? So this is the interest rate that bonds are paying, but what about the price of bonds? Because that's also part of the bond equation.
Sure. So if we look at the price, it's going to do the opposite of what this chart's showing. So this is actually going, this is a longer look back here. This is kind of a 3-year look back, just to kind of give you an idea of where the bond market prices have gone on average. And so, really you look here that recently in the last quarter, we saw bond prices move up as yields came down. But as yields have come back up in the last month or so, prices have gone back down, right? And that's naturally how that's going to work on average, is they're going to move opposite to each other. But what we're finding here is prices are finding a level of support just over the 200-day. That's good. I mean, naturally, what happens, unless something that's really surprising happens short term, naturally, as you come down in an orderly fashion to the 200-day, you start seeing buyers kind of support things, as long as something's not, inherently really surprising.
Yeah.
So for us, I think we look at bonds saying, okay, we're being paid to be patient. We're collecting yield as prices have come back down. But unless there's a wild surprise on inflation in the near term, I would say it's probably unlikely that prices slice their way through the 200-day, slice their way through this level that we held for basically 12 months. And then we kind of go from here and see how
Yeah.
policies play out.
So basically, it looks like the aggregate bond has settled back down close to where it started the year. But the good
Hmm.
news is that interest, the previous slide we looked at showed what the interest we've been paid, investing in the 10-year would have given us. So, like you said, we had a fun ride and but we're back to where we got on the ride, but we're getting paid. We got paid while we were for being on the ride in the first place. So,
Yeah.
so if somebody were to say, well, should I sell all my bonds and buy stocks, since stocks look good and bonds are kind of treading water and maybe earning 4% or something, should I just sell all my bonds and go into stocks since it appears that that's the momentum now?
Yeah, so I think it's a very interesting question, and that's going to come down probably to some level of like a planning overlay and how people are thinking. But it's two ways here. Bonds for us is we want them to be a supportive mechanism day to day because although we're optimistic on stocks, we also know that there's a lot of volatility there day to day, week to week. And so bonds for us right now are going to pay us to be patient, help us buffer day to day movements, and we do think short term, and what I'll define short term, let's call it end of the year to some point in the first quarter next year, we still think as the Fed is continuing to pull rates down, there probably is some upside there.
Okay.
And so that's what we're thinking.
So what about people who have cash? What do you think they should be doing, right now?
So I think this is an interesting question. So, I think we'll talk about, what history tells us and where the market could go with Trump and president, with the Republican overall government. But from everything we're looking at, and that's, economic signals, technical signals, I think probabilities are pointing towards we're optimistic. We're pointing towards it would not be wild to say stocks right now are excited. The market is excited, and we're likely to move up. Not in a straight line, things can change, but the odds I think point to positivity. So what I would say is, there's always noise, risk on the outside of saying, well, I don't want to put money in here. But the funny thing is we have two things working for us right now. One, early signs, the market is digesting things well, right? So that's always a good sign because the market is a beacon of truth of saying, here's what I believe, here's some prospects. And being at towards all-time highs, historically speaking, is more positive than it is negative.
Yes.
Usually gets all-time highs and people get scared there. Usually all-time highs beget more all-time highs.
Yeah. And you also have the Federal Reserve that's on a trend of lowering interest rates. So
Oh, yeah, and the market's been waiting for that since March of 2022.
let's have some fun and let's
Okay.
go and look at what has happened in the past when you have different administrations and those kind of things. So, kind of walk us through this particular chart right here.
Okay. Yeah, this was a very interesting exercise because we get questions a lot of, this person's in the seat or that person, when, this is definitely going to happen. So what we went through is an exercise early in the week to say historically, based on who's holding the presidential seat, how Congress is divided, what tends to happen with the market, just to give us some historical context. And so what I did is I went back basically to 1901 and we looked at the Dow because back then there was no S&P 500. There was the Dow, not as many companies out there. And I wanted to see what just happens on average. And so really, going into Tuesday and certainly waking up Wednesday, we had six things that could have played out. Okay. Six different variants. So what we could have had would have been a Democratic president and a Republican Congress. Market did not view that as a completely unlikely event. Historically speaking, if that happens, the market returns 5.21% during that regime. Okay. And that happens about 10% of the time. So it's a fairly healthy market environment. And it happens not infrequently, 10% of the time. The next thing that could have happened is we get a Democratic president and a Democratic Congress, right? So Democrats are holding both the Senate and the congressional side. Now, that is not, historically speaking, market does not tend to perform as well in that environment. You get a 2.8% return. And that happens about 33% of the time. So it actually happens a lot. It just doesn't tend to yield as positive market results. Then you have a Democratic president and a split Congress. So a split Congress, again, is where you have Republicans on one side and you get Democrats on the other. That is actually a very healthy environment historically. So in that regime, on average, you have an 8.68% return. But that's a very unlikely occurrence. You have 4.58% of the time. So if we look at this historically, we just saw this, or we're in it right now, should we say, right? So we've seen this under President Biden. Under Obama, we had this same situation on the second term. And then before there, then I'm pretty sure the last time this happened was Grover Cleveland, something like that in the 1800s. I mean, you
Grover
know,
Cleveland.
we don't even think about him as a president. Like he doesn't come up in the history books too much. That would be kind of the last time.
I think he's the last guy that got reelected with a gap in the middle. I think that's the last time. It was
I
like in
think you
the
might be right on that.
1800s or something.
Yeah,
So
yeah,
yeah, it's a long
you're right.
time since that's happened.
Long time since that's happened. So that's favorable, but it's very unlikely. So now we have to what we just got, right? What everyone voted. So Republican president and a Republican Congress. That tends to be a very healthy environment for the stocks. So in that side, you usually get a 7% return. Pretty good.
Yeah.
And
So
it's not infrequent either.
yeah, it looks like it happens a fourth of the time, but certainly because it just happened for us, it's 100% of the time.
That's right. That's right.
And so yeah, so this bodes very well looking into the future. So what do we take from this?
I
We
mean,
talked about, it's probably an opportunity for somebody who has cash to look into, maybe putting that to work. Bonds, we said, look like they might kind of stay at this level, but we're getting paid the interest to sit and watch that. The potential for uh, growth is there. What about technology? A lot of people, have bought technology stocks and they've gone up 2,000% or something. What about those people?
yeah, those people have been living high on the hog for a while. I mean, you've been paid to be in those. I mean, it's been a wild ride, but you're paid for it. So another thing I looked at historically, say what parts of the market tend to do well in the first year of a presidency, regardless who's in the seat. And certainly, if I look back at Trump's, first presidency, what happens? And actually, technology and growthier sides of the market tend to underperform in those regimes for a number of reasons. A lot of times because the market gets excited about new economic policies that can bolster things, and so money shifts to value to cyclical names, and money leaves kind of the old winners and goes into new ones. And we've seen that pretty regularly. And so I would say, I don't think it's unlikely, look at history, that people start taking money out of the technology names and moving it to other areas of the economy that will benefit with lower rates, with expansionist policies, lower taxes, all those types of things.
So it might be a good time to diversify if someone is concentrated in technology stocks. And, I think Bernard Baruch, who was the Warren Buffett of the Great Depression, he said you can never go broke making a profit. So if you diversify out of your tech
Yeah.
stocks, you probably have a lot of profit there, and you're not going to go broke doing that. Um,
Yeah.
so yeah, so it right now it sounds like what you're looking at is that we feel pretty good about where we go from here, and it looks like the economy should hold and interest rates may continue to come down. That's a very healthy environment for the stock market and the bond market. But as we always say, when things are rolling along too well, make sure you're not actually rolling downhill. And
That's right.
it's certainly
Yeah.
possible that sometime next year we could have a big bad bear. The market could get way ahead of itself, or some new event happens, or the policies that people think are going to be good turn out not to be, and then you have a big bear market. And so having a strategy to protect against that, especially for the people that we work with, right, that are over 50, who are retiring soon, that's really important.
I think that's right. I mean, for us, ultimately, when we build, our strategy and we look at things, we're building a strategy where we're playing the odds. That's all we're doing. We're playing probabilities, not absolutes, not guarantees. And everything we're looking at points to probabilities being higher than not that the market continues. And if we look at how the market's already reacted, I mean, there's a lot of positivity there. And so at the end of the day, we say, okay, we have a lot of things going for us. Things can change, but if I can't, put things forward and have confidence in this environment, it's going to be hard for me to find environments where I am. So that's one. And the second thing would be, yeah, is at the end of the day, markets correct. Markets move down. And so having that sell mechanism that's following us. And actually right now, the cool thing is our sell mechanism is following us as the market moves up. So it's always right back behind us to help lock things in if the market ends up being wrong about all this stuff. So hopefully that will give people confidence to continue to be invested, reinvest, and move money.
Yeah, and our strategy, invest and protect strategy is there's a time to invest and there's a time to protect. It's kind of
Yes.
like Kenny Rogers famously said, right? There's a time to hold them and a time to fold them.
Yes. That's it. That's it.
And so that's always important. All right. Well, Jordan, it was great visiting with you. Thank you for your insights. And
Of course.
again, please subscribe to this video. You guys don't want to miss any of this delicious content anytime, any week. So thank you guys for watching, and we'll talk soon.